Tuesday, February 16th, 2021, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at whether bond investors are complacent about inflation. Many of the apologists for low inflation or even deflation. People talk about deflation, which is outrageous in my opinion, because inflation is the excessive increase in the supply of money and credit out of thin air in a fiat currency system. That's what we get all the time. What we're talking about really when we talk about inflation in the mainstream media is rising prices, which is the consequence of inflation. So yes, I think bond investors have been complacent for years. They've been proven right about being complacent and about being long bonds or holding bond investments because the central banks have printed an inordinate amount of money and credit, inflation, to manipulate bond prices higher. And when bond prices go up, yields go down and interest rates stay low, and it keeps the Ponzi scheme economy going, the heavy consumption economy dependent on credit going. And that's what they want to keep doing. It keeps Wall Street happy because the more bonds that are issued, the more credit that is created, the more money they make. The other thing bonds do, because bonds reflect through their yields the cost of capital. So if the cost of capital keeps going down, the discount rate for assets like stocks, corporate bonds is lower, goes lower because the cost for them goes down as well, and the prices of these assets go up, and we get a financial bubble that we've had. But now, I think a lot of this funny money is flowing into real things, tangible assets. And I think people have been too complacent. One of the big reasons is that they think they can emulate Japan. Japan for over 30 years now has had very low interest rates, negative rates, huge amounts of debt. And they think that it's going to be the same for the Western countries. But I think they could be mistaken, and it could be really a big problem for their portfolios, for their wealth. And I think we need to keep an eye on this. And I found a really good article recently about M1 money supply, how it's gone up like 75% in the last year. Even though money velocity, that's another thing the apologists talk about, the inflation apologists, that money velocity is not that high, so we don't have to worry about rising prices, which is really what inflation, the consequence of inflation is, rising prices. We have had inflation, it's just that it's been a good kind of inflation. It's been in asset prices, it's been in real estate prices, it's been in stock and bonds, asset prices, but it hasn't been in real things. They're trying to keep it from rearing its ugly head through the commodities markets. But I think they're not going to be able to do that. They're trying to keep gold and silver down, even though JP Morgan, for example, is calling for a commodity super cycle, a new bull market. I think what they're trying to do really in the precious metals market is to try to really get out of their big shorts that they always seem to have in gold and silver, and they're trying to go long because they know what's coming. We saw last week as well the G7 finance ministers and central bankers come out and say that they're going to keep going big, as Janet Yellen said, and going big means more spending, more debt, more money printing. So yeah, this article here, it's in thesoundingline.com, charting new waters. I have spoken about money supply, M1 money supply, and I had explained how a lot of that money is going into excess reserves at the Fed. A lot of the banks that get that money from the Fed through reserves, they put it back at the Fed and they earn interest. They've been allowed to do that since '08 to earn interest on excess reserves. Prior to that, they had to try to earn interest through the real economy. And I think I've said that was one of the reasons I thought money velocity was not as strong. And before I go into the article, basically money velocity, or M1, let's look at M1, money velocity, is calculated, the fraction is GDP over money velocity, and that's how we calculate it. So GDP is the numerator and M1 the common denominator, and GDP divided by M1 then is the money velocity. But we've seen as well that over the last 12 months, GDP has gone down and the money supply has gone through the roof. GDP hasn't gone up 75%. Let's go over this article. It says M1 money supply growth hits jaw dropping 75%. Low money velocity won't stop inflation. And what he means, of course, is the rising prices, the consumer prices, which is associated with inflation. But if you've been following for a long time, I've always said that inflation is the creation of money and credit out of thin air. The reason they don't want you to think like that is because they want to pretend that there is no inflation by calling it the CPI and doctoring the CPI, of course. This article, by the way, is from February 12th, 2021. It's from someone called Taps Coogan. M1 money supply growth just keeps surging. It has now hit roughly 75% year over year, more than triple the previous all-time high from 2011. Two well-worn arguments get made to justify why this unprecedented increase in the money supply won't eventually cause inflation, rising prices. Neither argument holds up to scrutiny. The first argument is that the QE programs, which followed the global financial crisis, didn't result in pernicious inflation, at least not as measured by CPI or PCE. PCE is a measure of prices used by the Fed. That's even more of a joke. It never goes up. So therefore, neither will the current QE program. What the argument misses is that the first generation of QE programs never had much success at increasing the money supply, M1. So M1, just for those of you who don't know, those are checking accounts, cash and coins, and traveler's checks. Of course, traveler's checks are a thing of the past, but it is part of M1. I remember when we used to travel in the 70s, my dad used to carry around American Express traveler's checks. On the other hand, the current QE plus helicopter money program is proving extremely successful at increasing the money supply. The difference can be seen as clear as day in the chart below. The first argument is a moot point. So yeah, as I said earlier, in the past, when we've had the QE, M1 money supply didn't go up, and he's showing us this chart. Okay, the second argument, it says, the second argument is that the size of the money supply doesn't cause inflation. Instead, it is the velocity of the money supply that causes inflation. That is true. If the Treasury printed $10 trillion and nobody used it, it wouldn't cause inflation. Of course, you print the money and you put it aside and no one touches it. Yeah, it wouldn't. He's right. And this is where it's getting interesting here, because he's looked at something that I hadn't looked before and that I hadn't seen anyone look at. It says, however, there is an important caveat. We cannot directly measure money velocity. People may imagine that the Fed is tracking how many times a dollar gets spent in a year, but they're not. The current velocity figures are inferred by dividing GDP by the money supply. The result is a very imperfect measure of velocity, especially when one recalls that imports are subtracted from GDP and government transfer payments are not counted. So GDP, the definition of GDP is consumption plus investment plus government expenditure plus, and then brackets, exports minus imports. And of course, the United States runs, I think the budget, not the budget, sorry, the trade deficit is almost $1 trillion now, if I'm not mistaken. So let's keep going. Take just one example. Imagine that Congress sent everyone $2,000, the Fed and foreign treasury buyers monetized the increase in treasury debts, and everyone receiving checks immediately rushed out and bought imports from China. Retailers then restocked, sending money to China, paid their employees from the profits, the difference between retail and import prices, and the employees went right back out to buy more stuff from China. Repeat that process as many times as you like. The whole affair would be more or less invisible on the money velocity calculation. The imports would be subtracted from GDP, as I said. The increase in money supply would be reduced as dollars flowed to China and then recycled back into the US in treasury holdings, which aren't counted in M1 or M2. Money velocity calculations don't work well in an import dominated economy, and that's the key point there. This is doubly true when the largest source of imports pegs its currency to the importer. Not too sure about that because the dollar's been dropping almost precipitously versus the yuan. More fundamentally, so that's going to make even the imports be even more expensive. So they're going to need even more money to buy these imports, I would say. More fundamentally, as long as the increase in GDP that results from money printing is less than the money printing, velocity will fall the way it's calculated today. So we've spoken about that when I was looking at the fraction and how you calculate M1 money velocity. Perhaps more importantly than all of that, it is not the level of velocity that matters, it's the direction. A small increase in velocity when the money supply is very large can cause a lot of inflation or rising prices. Zoom out and the whole thing gets a lot more clear. The Fed's prior monetary expansions didn't work because the money never made it out of the financial system. This time the money is making it out, but a lot of it is still being saved. When it gets spent, it will be inflationary. Don't expect forewarning from the velocity number. So that's why I think investors, consumers are complacent about rising prices or inflation because they keep looking at this velocity number. They see that it's near 1 and they say, oh, there's no problem. But it's more complicated than that, as Taps Coogan talked about, and as I have been talking about as well. So the other thing that I've been talking about is the bond market. The other day, I showed a chart of how the amount of negative yielding bonds has dropped by over $2 trillion in the last few months, I think. I showed a chart from Tavi Costa. And that's a bad thing because I think that's the last thing the powers that be, the central banks, the finance ministers want. They don't want to see bond yields going up too quickly or going up at all. They want to see them stay low. And someone might say, well, they just do QE and keep it low. But I think if investors start seeing commodities continue to rise, they start seeing prices of things go up, I think it's going to be very hard for the central bankers and governments to keep control of interest rates. They might not be able to print fast enough to cover for all the sales by investors. And I saw an article here yesterday from Zero Hedge, because we've seen that treasury yields have been going up. They're at multi-month highs, but so are other bond yields around the world, especially in Europe. It says surge in Bund treasury yields spark slump in negative yielding debt worldwide. Bunds, of course, are German government bonds. And I had a look not only at the German government bond 10-year yields, but I had a look at the UK, the French, the Italian, the Japanese, and they're all going up recently. Yes, they're still at very low levels, but the important thing is the trend. And I think that's worrying. So I've got a few charts here and some data for you. I've gone back to, 2006, because I always remember Jim Sinclair saying that you need 5 golden pillars or 5 conditions for a massive bull market in gold. And one of them is a recognized top in the US dollar. The other one is trust in USA paper assets declining. So I guess that would be a flow away from paper assets into tangible assets. Bullish general commodity markets, which is a mirror. It's like the flip side of that coin of trust in paper when people go into commodities. Yes, it can mean that the economy is doing well, and that's what they're hoping. The bankers, the central bankers, the politicians, that this is just a reflation trade, the commodities trades. But I have a feeling it's more a reflection of all the funny money, the trillions upon trillions that they've created in the last 12 months. And also in the last 12 years, it's going to come home to roost, because why should developed Western countries be able to do this, to print money and for their currencies to stay strong, while the poorer, less developed emerging market countries, if they do that, of course, we know that they get massive price rises, their currencies collapse. So I personally think the time is very near to when these people are going to be shown to be wearing no clothes, because it's against the laws of nature for people to create something out of thin air and to keep getting something for nothing, because that's what it is. So, and commodities, in my opinion, going up is basically the currencies dropping massively. So what's the other pillar? Triple deficits of U.S. budget. Well, yeah, that's not going to go away, the budget deficit in the U.S. Current account not going away as well. And trade deficit in place. I think that is definitely in place. And then this is the important part. This is, I think, the last piece of the puzzle that I think we could be getting close to. And that's a recognized top in U.S. Treasury long bond. So the long bond is the 30-year bond. Yes, most people look at the 10-year note yield, but the long bond yield is also very important. And you might ask, well, yields have been going down since 1981 and gold has gone up. That's true, but I think if you get a bear market in bonds and yields rising, the bull market in precious metals and commodities is going to be even bigger than we've had this century. And for those people who think we can't have a bull market in precious metals and commodities with yields going up in a bear market, look at the 1970s, what happened, I would say. So, yeah, I was thinking about those 5 golden pillars, and I haven't seen Jim Sinclair or Bill Holter talking about that recently. That was from 2006, as you can see there. And I think we're getting quite close to those 5 pillars being satisfied or being in play, those 5 pillars. So let's look at some of those pillars in terms of charts. So we look at the dollar index here. I've been saying for the last three years or so that I think the top in the dollar index was in January 2017. Yes, last year it did rebound almost back up to that high, but I think that's a recognized top, especially seeing that we get 7 to 9 year cycles, as you can see here, roughly from this long-term dollar index chart. So what's the other one? Well, a bull market in commodities. We've been looking at this for the last few months. Rafi Faber as well, who's been on the channel, he's talking about this as well. Well, look at that. That's the CRB index. The last really major bull market was from around 2002-3 to 2008, and we've been in a bear market since then, really. But now it starts. It seems like it's starting to go into a new bull market. Commodities. The other pillar, of course, is the long bond, a recognized top, and that's like I guess right now it's still a tricky determination to make, a recognized top, because we could bottom and then make another high, another top, but we'll have to see, especially with the yields going up. So in bonds, when the yield goes up, these prices go down. So yeah, it looks like there's a recognized top here in the long bond, and this is the T-bond future, going back actually to the late 70s. Futures, of course, they go off the board. Let's say the March T-bond future will go off the board, and then the June will become. But what they've done here, they've put together all the near months throughout time. So yeah, it looks like there was a top here. There was even a spike higher. I think that was last year during the crisis. It almost went to 200. And don't forget, bonds are issued at par. So the fact that the price went almost to 200 was a massive move higher. So is it going to be a recognized top? We'll have to wait and see. But it looks like it for now. And then the deficits that he was talking about. I wasn't really able to get the current account deficit, but that would be fairly close to the budget deficit. We've got here, as you can see, the budget deficit, which is running at over 3 trillion. I mean, this is crazy. I remember when 200 billion was a big deficit. And there's even an actual one underneath here, which is almost 5 trillion. It's crazy. And then you've got here, as I said, the US trade deficit is almost approaching 1 trillion. And the trade deficit with China, of course, 306 billion. So it looks like the 5 pillars might be there. So let's look at where the yields are this morning. Before we go to look at the other markets. So yes, they're continuing to rise, and that's a worry for the powers that be. The 10-year yield now is up 3 basis points at 123. Where do I think they'd get worried? Well, if we go through 130, we could see an acceleration of the 10-year yield higher. These yields are not supposed to move too quickly. They're supposed to be stable because the US dollar is supposed, and treasuries are supposed to be the risk-free rate of return. It's supposed to be a safe haven. Safe havens are supposed to be stable, not trade like cryptocurrencies. The 30-year, the long bond, up 3 basis points as well, around 203. So that is worrying right now. We're going to have to keep an eye on this. The German Bund yield, as you can see, is still negative. The 10-year yield for Bunds still at minus 39. But as you can see, it's been rising slightly. This is a weekly chart. So I think the last time it was positive, if we look here at the chart, was back in 2019. So last year during the crisis, it got up to minus 14 basis points or thereabouts. So yes, it's not just US yields going up. it's yields all over the world. I could look at some other countries, but I think Germany is a benchmark outside the US. Those are the two biggest, really, well, maybe not the two biggest. The US definitely the biggest. You got Japan, the JGBs. They're starting to move up a little bit as well. So yes, I think bond investors in general, are very complacent about the bond market, and we have to really keep an eye on this. And looking back at Jim Sinclair's pillars, it seems that the only pillar that's not in place really totally is the recognized top in the long bond price or bottom in the yield. So let's look at where we are then. It's 8:36 a.m. London. We've got spot gold, 1821.50. That's up $3. Range has been 1827 to 1817. Silver is traded up almost up to 28. The high is 27.97. Right now it's up 10 at 27.67. Low has been 27.51. The Dow future is actually unchanged. NASDAQ is down 15 points. S&P is down about a point. So stock market fairly quiet, but I think it's discounting here. My system is discounting the move from yesterday. So because yesterday the markets were closed, but I think the futures were up almost 200 points. So compared to actually Friday, we're higher, but compared to yesterday, we're unchanged. So yeah, the stock markets did move up yesterday. The currencies, fiat currencies, the pound is up about 1/8% at 139.20. The euro is up 1/8 as well at 121.40. The dollar is up slightly versus the yen at 105.46. And the dollar's rebounded a little bit against the yuan. It's at 641, but still at very low levels. It looks like that 640 level is now keyed. I'll just show you a chart of the dollar versus the yuan. I mean, I think that's kind of a recognized top in the US dollar. So this is how many yuans you get for a dollar. So the dollar has been dropping, and I think is going to continue to drop. Of course, most people still use the dollar index as a measure of dollar strength, but I think it's important also to look at the Chinese yuan, seeing how important the Chinese economy is. So there you go. That definitely looks like a double top in the dollar. We've gone through 650, which was the objective of the double top that I had. So now really, I think we're going to go test the low here from March 2018, which was around 623. And I think that could be a very key level now, 623 in the dollar versus the yuan. What about the other commodities? High-grade copper up slightly this morning at 382.70, less than 1%. Very little move, actually. WTI crude is back down a little bit here, below 60. It's down 0.5% at 59.84. So there you go. Let's keep an eye on everything, really. Sometimes in financial markets, we need to keep an eye on all different kinds of assets, indicators. It's not just the stock market. It's also yields, precious metals, commodities, currencies. You have to, or else you're going to miss a lot of the signals that are out there, in my opinion. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.